Hi everyone. I was asked to say a few words about the FSA before actually launching and describing our research. The FSA stands for the Financial Services Authority, the UK's statutory financial regulator. Since the Financial Services and Markets Act passed in 2000, we've had responsibility for capital markets regulation as well as for retail markets regulation, so it's quite a broad remit. Our research presented today will focus on capital markets and more specifically on the UK listing rules. The presentation follows a very traditional structure. I talk about the easy parts, policy background, structure of the UK listing rules, and the academic literature which we reviewed to inform our own research. Christian then describes the methodology of our own event study as well as the results we obtained. Now, the whole research was really inspired by some recent consultation paper on the structure and scope of the UK listing rules. To understand these consultation papers, it's perhaps helpful if I say a few words about the UK listing rules. They distinguish between so-called trading companies. I'm thinking here of common and garden variety companies such as Tesco, and investment entities, that is funds and the like, which abide by an investment policy. And the listing rules differ for these two types of entities, really. For investment entities, we have a super equivalent listing regime, that is a listing regime which contains the regulations prescribed by European directives, as well as some regulations that go beyond this minimum standard. And the big question here is, how much should we really go beyond the prescribed directive minimum standard? For trading companies, we currently operate two distinct listing regimes. Domestic trading companies, that is, UK domicile trading companies, currently must have a super equivalent listing, whereas overseas trading companies have a choice between either directive minimum listing regime or a super equivalent listing regime. And the debate here is whether we should align the two regimes and whether, quite specifically, we should grant the same choice between a directive minimum listing regime and a super equivalent listing regime to UK domiciled trading companies as well as to overseas trading companies. Now, when advising on the policy proposals that were canvassed in recent consultation papers on the future of the UK listing rules, the first thing we did as economists in the Strategy and Risk Division was to have a look at the academic literature, because it's already there, and maybe we thought we can get some insights from there for our decision making. Our literature review really has two parts. First, we looked at the valuation effects, the benefits of corporate governance standards more generally, so that could help to determine how much regulation there should be. The overarching conclusion from many of the cross-country and cross-firm studies, as well as some event studies focusing on regulatory changes and movements by firms between different listing segments, appear to be that higher corporate governance standards tend to be associated with higher valuation. However, one would expect that there are some diminishing returns, or at least a point at which the additional compliance costs outweigh the potential benefits in terms of greater reassurance to investors. And the Sarbanes-Oxley might conceivably be an example of an act which imposes very significant compliance costs on firms, which might even exceed the benefits in some industries. Therefore, unfortunately, we found it very difficult to reach a conclusion based on this literature that would help us to answer the very granular questions we were grappling with in relation to the UK listing rules. So, for instance, shall we have an additional shareholder vote before certain types of decisions or not? Should certain further information be disclosed or not? Should it be disclosed on a monthly basis or on a quarterly basis? So these very specific questions could not, unfortunately, be answered by what we found in the literature. The second part of the literature review we undertook focused more specifically on this question I mentioned earlier, whether listing standards should be mandatory, applying to all firms, or optional, so that firms can actually choose how super equivalent they want to be. At a theoretical level, the arguments seem quite simple. Basically, mandatory standards provide assurance to investors that the same high standards prevail in a market, whereas voluntary standards allow firms to choose the optimal level of regulation which is suitable for their firm and their investors. Maybe we answer questions at the end. However, when we looked at this question empirically, we found very few studies from which we could extract information about the significance of these relative effects, and specifically in relation to the UK listing rules. We found a very interesting US study by Bushy and Lloyds, which focuses on the effects of the SEC's 1999 disclosure requirements. And this study distinguishes between firms that voluntarily complied with these higher standards before they became compulsory, and firms that complied only when they had to comply. And interestingly enough, the authors find that the firms which already complied with the standards before they were introduced experienced positive valuation effects when the standards became compulsory and applied to other firms also. So it's possible that they benefited from positive reputational spillover effects. We looked at another study by Bruno and Arco focusing on the UK Combined Code. As mentioned earlier, we have a comply or explain approach to the combined code. So the authors formed two portfolios of firms. As firms in the first portfolio systematically complied with all the provisions of the combined code, and firms in the second portfolio complied with some of the provisions and explained non-compliance in other instances. And interestingly enough, the authors found that the firms which adopted a sophisticated comply or explain approach performed better than the firms which adopted a tick box compliance approach. These studies seem to be very disparate in many respects. However, they highlight one common theme, which is that information really matters. Specifically, what matters is investors' ability to assess the standards firms need to live up to and to price that in. And only when we know this, we can reach a fully informed decision on whether standards should be voluntary or mandatory, and in what areas. So again, there seem to be some remaining open empirical questions. So we were exploring the scope of some little study of our own, which would focus on UK-specific issues. We hope that we might be able to exploit information about the valuation of firms that choose to list on different UK markets subject to different regulatory standards. We were thinking specifically of the London Stock Exchange's main market on the one hand and AIM on the other hand. As you know, the LSE's main market is a so-called regulated market. So issuers that are admitted to trading on that market have to comply with the FSA's normal listing rules, be they primary or secondary. By contrast, AIM is a multilateral trading platform. And therefore its rules are really made by the LSE itself by and large. So there seems to be quite a significant underlying difference in regulatory approach. In practice, some of the requirements that apply to the two markets are very similar or even the same, for instance, where market abuse is concerned. However, I listed some differences. As far as the admission process is concerned, the differences include that on AIM there's no minimum free float requirement, there's no 3-year trading record requirement for trading companies, and no minimum market capitalization, as well as a few other differences. Apart from the initial admission rules, we are also interested in the continuing obligations. There are also a few differences here, notably in relation to large transactions, large acquisitions or disposals, as well as related party transactions, which are more commonly subject to shareholder approval requirements on the main market. There are a number of other differences as well, including the procedures for fundraising, corporate governance standards, including the application of the combined code, and the nature of financial disclosures to be made. So now what are we going to do with these regulatory differences? We thought that, well, we are really interested in the extent to which they might affect a firm that decides to list on the one market or the other, and more specifically firms that choose to switch between the two markets. That really allows us to design an event study, and Christian is going to explain the methodology of this study. Thank you.
So what we decided to do was really to design an event study which looked at the fact what happens to the share price of a company when this company announces a switch from the main market to AIM or vice versa. And I'll quickly take you through this event study, what we do by first presenting the hypothesis we want to look at, then looking at the, describing you the data set we have, and then briefly talking about the methodology. Upfront, when we do this event study, checking what happens to the share price around the announcement of the switch, then we might have the following results. We might see that the values increase for moves from the lighter regulatory regime to the tighter regulatory regime, and also the other way around. Then this would point to benefits of giving a choice to companies for choosing tighter or lighter regulation. They really can choose the regulatory regime which is appropriate for them. The second possibility would be that the value of the company or the share price would fall when a firm is moving from the tighter regulatory regime on the main market to the lighter regime on AIM. And values could increase for moves from AIM to the main market. Then this would be kind of an indication for a benefit of a high across-the-board regulatory standard. And the third outcome could also be that values would not be substantially affected by regulation. So nothing really happens when a firm announces a switch between the two markets. This might indicate that the regulatory differences between those two markets might not be an important factor for investors. Or it's even also possible that those announcements are kind of anticipated because it's kind of a logical step for the firm. There's one important caveat to this kind of study we are doing. It's quite an obvious one. There are a whole lot of factors other than regulatory differences that might explain the share price reactions we observe in this study. Looking at the data, we look at a period from 1996 to 2006. I should quickly mention the AIM market was established in 1995. We look at the period from 1996 to 2006, and moves from main market to AIM we have 268 in total over this period. And what is quite interesting is that the number of switches between the main market and AIM really kind of takes off in 2000. In the other direction, moves from AIM market up to the main market. We observe we have 102 firms doing that kind of switch from 1996 to 2006. And here it's also quite interesting to note that the number of firms doing that switch, moving up to the AIM market, moving to the tighter regulatory regime, kind of is trading off after 2000. And then actually creating the sample for our study. What we do is we cannot use all the firms we have available. What we do is we exclude foreign firms due to the, and investment entities due to the reasons Susanne has mentioned, because their regulation is kind of different to trading companies. And we also exclude firms that make major announcement around the time of the announcement of their intention to switch between the markets, like mergers or profit warnings, because this might really blur the reaction we observe. So that leaves us then with 67 firms out of 102 moving from the lighter regime on the AIM market to the tighter regime on the main market. And with 190 companies doing the switch from main market to AIM. And there was one thing which was really kind of striking when we looked at the firms and the announcement of their switch, that a large proportion of firms announced an equity issue alongside their intention to switch between the markets. And so we decided to look to have kind of two samples and look at the equity issue example separately from our clean sample, where there's only really the announcement of the switch between the markets. Now, let me quickly describe our event study, the methodology, and I hope the next slide isn't too patronizing for an audience of academics, but it, I think, kind of describes very clearly what an event study is doing. We are looking at a period around the announcement of the switch, and what we try to establish is whether the share price of the firm behaves abnormally to what we would expect the share price to behave during the period. And I also quickly describe the technical details how we established these issues. And the important thing is then really is the cumulative abnormal return around the event window. Is it significant, or does it tell us anything or not? And the first thing is to measure the baseline is the expected returns model. What would we think the share price should behave like? And basically we use the market model. And if the result of this was not significant, we use the constant mean return model. Why did we do that? We have kind of an odd sample. The firms we are observing are quite small. On average, the firms moving from AIM to the main market have a market capitalization around at the time of the announcement of their switch of around 70 million, and 75% of these firms have a market cap which is smaller than 75 million pounds. And for the firms moving from main market to AIM, it's even like 75% of those firms are smaller than 25 million's market cap at the time of the announcement. So this is a sample of quite small firms that are really at the lower end of each market and that are quite thinly traded. So quite often the results when we use the market model, when we regress the return on the market index, which would be the FTSE small cap index, are not significant, and then we revert to the constant mean return model and basically taking the average historic return of the firm. We estimate this expected return with an estimation window, which is also kind of standard, of 240 trading days before the event window. And we look at the abnormal returns in an event window of 2 days before the announcement until 2 days after the announcement. So a total of 5 days. And we test for significance with creating a distribution generated by bootstrapping with 10,000 iterations, and then we do kind of a weak test for significance, a one-sided test for significance at a 10% level. We also did quite a lot of robustness checks to see whether the results I present to you in a minute are robust. We did some fiddling around with the event window and checked whether applying different event windows in the period of 5 days before the announcement and 5 days after the announcement would change the results, and they do not. The same thing, we played around with the estimation window, because you could say, like, starting the estimation window 2 days before the announcement might be too close to the event window. This might kind of blur the results, but also using estimation windows starting at 20 days or 40 days before the announcement didn't change the results, and also applying a post-announcement event window didn't change the results. And we also played around with different returns models. Again, results didn't really change. So then, let's move to the results of our study. Let's first look at firms moving from the lighter touch regime on AIM to the tighter regime on the main market. And we have 30 firms in our clean sample and 29 firms in our equity issuer sample, so not really very much. And what we see, the equity issuer sample, we see predominantly large abnormal returns in the event window, 6.9% on average. And for the clean sample, we see on average very small abnormal returns. And I have to make one caveat here. The statistical significance of those results, even when we apply only a one-sided test at a 10% level, are really quite weak. So then let's have a look at the other direction. Firms kind of moving down, as everybody says, from the main market to AIM. Sample size is a lot bigger. We have 48 firms in our equity issuer sample and 136 firms in our clean sample. And the equity issuer sample, there we observe quite large negative abnormal returns, 9.1% on average. And also the median is really quite negative. And in our clean sample, we also observe mostly negative abnormal returns, but on a really much smaller scale than for the equity issuer sample. So we now have those results, and we are in a way kind of, when I refer back to the hypothesis we had, for our equity issuer sample, we observe negative returns for firms moving down to the lighter regulatory regime, and positive returns for firms moving up to the tighter regulatory regime. This kind of gives an indication that our second hypothesis, a benefit of high across-the-board standard, might be true. But the situation is kind of different for our clean sample, where it's really only the announcement of the intention to switch. Because there, the values really don't seem to be substantially affected by this intention to switch between the markets. And this is kind of an indication for our third hypothesis, that the value of a company is not substantially affected by regulation. And so we are kind of left with a puzzle here, because like the firms we are looking at, we have quite different results, and they are also not really statistically significant. So what we try to do is to investigate into more depth what might be the drivers behind the results we've observed. And I'll take you through the most of these kind of indicators to explain why we have the results that we have. And Suzanne will tell you something about the liquidity effects later, but I take the signal of performance effects hypothesis first. As kind of a background to this, we really have, as I said, the firms we have in our sample are really quite small. They are mostly below a market cap of 75 million, and we have only 6 firms that have a market cap of more than 200 million. So they are really at the lower end of the market. They are very thinly traded. They are basically below the radar of analyst coverage. So what we thought might be an issue here is when those firms announce a transfer between AIM or the main market, or the other way around, they kind of get the attention they normally not get, and then the announcement of the transfer between the different venues might be might be understood as kind of a signal of performance of this firm. And when a firm moves from the tighter regime on the main market to the lighter regime on the AIM market, the signal might be, this is kind of a loser. This is a firm that may have financial difficulties. And an indicator for that might then be that this firm has had weak historic share price performance. We measure that as outperformance against the FTSE Small Cap Index in the 2 years before the announcement to switch. And it also has a negative abnormal return at the time when they announce their intention to switch. A signal of performance effect for a firm graduating from AIM to the main market, there the signal might be the switch is kind of a signal for a growth story. This firm is growing, it's kind of having a strong historic share price performance. And if this is true, we should also observe a positive abnormal return when a firm announces its intention to switch between the markets. And so, let's see what happens there. Let's look at firms moving from AIM to the main market first. And we have 21 firms in our equity issuer sample here and 20 firms in our clean sample. And in both samples, what we see is those firms are really historic outperformers against the FTSE Small Cap Index. And the outperformance is quite large, like 200% on, some 200% on average. And it's not really driven by outliers because the outperformance is also really large when you look at the median. And then when you look at the abnormal return, there's really kind of a difference between our two samples. For the equity issuer sample, we still have this abnormal return of 6.9% on average that I described. So you might think that there we have a signal of performance. But when you look at the firms that only announce their intention to switch, nothing really happens with the share price when they do this announcement. So we might have the signal of performance effect for equity issuers moving to the main market, but not for our sample of clean firms. When we look at firms switching from main market to AIM, there is, in both samples, it's quite a clear tendency that those firms are historic underperformers, which might be an indication that they are in financial difficulties. And then when you look at what happens at the time of the switch, then we have again strong negative returns for the equity issuer sample and small negative returns for a clean sample. So again, in terms of signal of performance effect, there might be an indication that this is true for equity issuers, but not for the sample of clean firms. So what we concluded there is the signal of performance effect, we might see that for our equity issuer sample. And then it's the announcement of an equity issue alongside the announcement of the switch, which might give investors a signal of performance. So like when a firm moves up to the main market, this is a signal, is a growth story. There might be profitable investment opportunities they need the money for. Or when a firm moves down to the AIM market, it's kind of a signal for financial difficulties and the firm needs the cash to finance a turnover. And what we did then is to check what happened after the time of after the announcement of the switch and the 2 years after that. And so when you look at the firms moving from aim to main, on average, those firms, independently if this is in the clean sample or the equity issuer sample, on average underperform the market by around 20%. And in a way, that's kind of a result you would expect for the equity issuers, because this is really a result which is consistent with the literature on seasoned equity offerings and also IPOs that have an underperformance after the equity issue. And when you look at firms moving from the main market to AIM, the picture is not as clear. Again, the equity issuers do on average underperform, which is again consistent with what you would expect. But for the clean sample, the tendency is not that clear. The average outperformance is a lot smaller, and the median is about 0, and we have more negative performances than positive performances. So to conclude there, it's like this hypothesis that firms can get out of the radar and send a signal to the market only holds and seems only to be valid in certain circumstances when really a firm is also issuing equity, because this seems to be a really major event in the history of the firm. And now I quickly hand over to Sen for some discussion of liquidity effects.
This is really only a comparatively minor slide. Essentially, I thought there was that liquidity affects the ease with which an investor can realize his asset at short notice. Investors might therefore appreciate the greater liquidity that can be found on the LSE's main market relative to AIM, and therefore liquidity effects could impact abnormal returns around the time of an announcement. So we dutifully collected data on absolute volumes traded, bid-ask spreads, and I think volumes over shares outstanding. But unfortunately, or fortunately perhaps, we couldn't find any evidence to confirm this hypothesis of liquidity effects.
Then it's back to me. And one other obvious thing that might influence the share price when a firm announces its switch between the two markets might be that switching between the main market and AIM could lead to inclusion or exclusion in FTSE indices, or also to inclusion or exclusion in investment mandates. And this might obviously have demand effects with consequences on the share price and liquidity, but we found no evidence that this might be an issue, because basically the firms in our sample, this is really kind of an odd sample, are too small to matter. Because 75% of the firms that moved up to the main market are smaller than 75 million market cap, and that's basically at the moment around the threshold where a firm is included in the FTSE small cap index. And also, those firms are basically too small to matter for investment managers, because normally when you speak to investment managers, they are only interested to invest in a firm above a market cap of 200 to 250 million pounds. And even for a passive mandate, the trade-off between the tracking error and the trading costs might be such that the passive investment manager is not really interested in investing in such a small share. The other thing which might be an issue is the different tax treatment between AIM and the main market. Because from 2000 to 2007, here in the UK, we had quite a significant different treatment with respect to capital gains tax. AIM shares profited from taper relief. And this was a thing that really puzzled us at the beginning when we did our study. Because this taper relief could in principle really have a quite significant impact on valuation. We did a quick check, like assuming simply a 7% growth rate of the stock over a certain period of time, and the net present value of the difference in valuation could then be up to 10%. So this is really could really, in theory, have a significant impact. And what you would expect there is you would see increasing abnormal returns for issuers moving down to AIM, and decreasing abnormal returns for issuers moving up to the main market.
Could you just define taper relief?
Taper relief is basically a relief on capital gains tax. So you have to pay less capital gains tax on when you own a share on AIM. For every investor. No, also for every private investor. Yeah. That was really like to foster investment in the AIM market, and this tax relief was introduced in 2000, was even reinforced in 2002, and was taken away this spring in 2007.
And what's the normal capital gains tax rate?
I think it depends. Well, I'm not living in the UK for such a long time, but it basically depends on your personal income tax rate. It can be 40% or 20%. Okay, and the other thing why we thought this might be really an issue, because this tax advantage was introduced in 2000, and what we observed, like when we looked at our data, is that it was really a tipping point in the numbers of switches between the two markets. The AIM to main switches were really going down, and the tax disadvantage for main shares was also introduced at that time, and the switches from main to the AIM market were really going up after the time this tax advantage was introduced. But when we did look at our sample, we don't observe the effect that we have like lower cars for firms transferring to the main market before or after this this time of this introduction of the tax disadvantage, and the other way around. And we don't observe like lower cars for issuers transferring to the main market at all. And also, if we observe those tax effects, you would also expect that this would be similar for all firms, and this can absolutely not explain the differences we observe between our sample of firms issuing equity and our clean sample. So this tax effect really seemed to be quite important, but in the end, I think it's a red herring in order to explain what happens with the share price when a firm moves between the two markets. And with that, I hand over to the conclusions and hand over to Suzanne.
Well, we need to conclude with what we cannot say, as well as with what we can say in the case of our study, really. So what we cannot conclude from our results is that the regulatory standards, the difference in regulatory standards between the two markets does not affect the valuation of the larger issuers which would not contemplate switching regimes. All we can say is that for most of the firms which our study actually focuses on, the differences in regulation between the main market and AIM are either not a significant factor driving valuation at all, or not one which we can isolate empirically for different reasons. And it appears that expectations about future growth appear to matter more than regulatory differences, at least for those firms which announce an equity issue together with their intention to transfer between the markets. And that's it from us.
Thank you very much.
So of course we would be happy to answer questions on all parts of the presentation. Should we do this?
Sorry, I was standing in the light of the projector and couldn't see anything.
So as you were talking about some of the four reasons for switching, trying to get some more understanding about why firms would switch up or switch down, it struck me that there might be something interesting to be explored between was he pushed or did he jump? So in other words, are there firm-specific characteristics that explain some of these moves? So you have univariate statistics that kind of parse the samples into piles and look at that, but did you try any multivariate models where you're going to regress some firm-specific characteristics, reasons for switching, which you have in one of your appendices, on, regress cars on those firm-specific characteristics?
Actually, we did not. What we tried to do is the reasons for switching. We tried to find those ones out, and looking at the announcements the firms have made and whether they are citing financial difficulties, whether they are citing the growth story, and we did some basic descriptive stats on that, and there was not really a pattern in there, and it's. Yeah, but we did not do multivariate analysis on that because the data we got for the reasons for the switches and this kind of characteristic that was not reliable enough really to justify putting it into kind of a multivariate model.
So just a quick follow-on question. In one of your slides and on page 18 of your paper, you say that the minimum listing requirement is £700,000. Is that right, £700,000 to be on the main market, or is that a typo? It seems very small to me.
I would need to confirm this myself. That's not my area of expertise. I mean, I hope there are no typos on there because it's copied mostly from our occasional paper, but I would need to double check.
I really like the results, and they are similar to the papers which have been done previously, as you pointed out, for NASDAQ to moving to New York Stock Exchange stocks. And one thing has always bothered me about this, that if it's a signaling story, at the announcement the returns are positive. But in the next certain time periods, and you showed some of those results, the results are negative. So it seemed like, maybe you have comments on this, that the investors are fooled by either advertising or some kind of publicity that this is a good move to New York Stock Exchange or to the main market, but then they suffer. Is that what's going on there? I would like to know your comments.
Well, I think the interpretation is kind of different for for the firms which also issue equity alongside this announcement to switch, and the findings we have there for the long-term performance after the switch is really kind of in line with the literature on equity offerings, that maybe firms really like to use a window of opportunity to issue kind of overvalued stock or something like that, and it's. In a way, it's something we kind of have expected to find there, because that's really quite a kind of established fact in the literature. Yeah, and maybe you're right. Like investors are fooled there, but yeah.
I'm interested in the word equity issues that you use. What kind of equity issues were these? Were they the same kind for both the aim to main and main to aim, or were the private placements involved in the case of the shift from aim to main?
I think those were basically really kind of issues of common shares. And that's basically it.
But did you look at the issue method?
No.
Because what you tend to find is that placements tend to be positive. Yeah. You have a positive reaction to placements, and rights issues negative.
But actually, let me think about that. I think most of those were. I think they were not private placement. They were rights issues.
Okay.
Yes. Sorry. Yeah.
The sample of firms you've got on AIM, when you look around the announcement date, do you actually have the prices on each of those days? Are those the traded prices?
Those are the traded prices.
So these shares are actually traded every day?
That's also one of the problems. It's really a sample of thinly traded firms. But when, like in our estimation window, we have really periods where for some of the stocks, those shares are traded like only once a month or so. But generally, when you are in the event window, those firms are traded normally. There are also some exceptions where they are really not liquid, and they are also not traded every day in the event window. But generally, in the event window, they are. In the estimation window, they are not. Which is also really kind of a problem for, in terms of statistical significance of the results, obviously.
This is just a wild guess, but wasn't there this paper long ago by Bloom and Stambaugh about thinly traded stocks that are just bouncing between the bid-ask spread? So if there's no trading, you're going to see zero return, right? And then when they move, from one to another, there's probably some trading as people change their positions. I'm not saying I can explain everything, but a combination of very little trading during the estimation period and more trading between the bid and ask spread during the event period, combined with observing a positive return, which is spurious, when something just bounces up and down between the bid-ask spread for low-price stocks.
This, you're right, and we also tried to deal with the thin trading issue at all. Like, we also tried some lead and lag variables and all stuff, but also didn't change anything. But you're right, this might be an effect we might observe. But then also, in a way, when you look again at the historic performance of those shares, then you would see a lot of shares basically with a flat performance over a year or two before the announcement. It's really only bouncing back. There's no trade, and maybe bouncing back between the bid and ask spread. But you would hardly see any really significant outperformances, positive performance or negative performances when there's no new information and there's only bouncing between the bid and ask spread. And what we generally see, like this historic performance, is normally quite the share price changes over a year or two. They are really quite significant and quite large over the whole sample. So in the estimation window, there's still some change going on. Maybe there's nothing much happening over a month or two, but then you have kind of a jump or kind of upwards or downwards, and it doesn't really correct itself directly afterwards. I think that's basically what we have seen there. Does that answer your question? Yeah. Because we were really worried also about this thin trading issue, and really looked quite closely at what happened at the with the share price in the estimation window, and we are clearly aware that we have a problem there in terms of significance of the results, but we are quite sure that basically the direction of our results is quite robust, and we also checked this with our academic referee. So we are quite happy with the direction of the results, but there are clearly problems with the significance of the results.
But with many of these companies, with the AIM companies, my impression about the AIM companies is many of them don't even have proper quotes and trades reported. They are not like publicly transparent prices, etc. And that's one of also the reasons why their regulation is so low, where even their corporate governance need not be is not properly regulated. Their listing requirements are extremely low. But that's also partly because it's not heavily traded. These shares do not attract much interest from the public investors at large, and so they are not even having proper trades and quotes, the bid and ask properly reported on them. It's almost like a pink sheet trading. You just trade at a price which you think is the best price, and that might be far away from actual market prices if there was regular market prices going on. I think that might explain a lot of why you don't find statistical significance, because there is, as Jake was pointing out, there is a huge amount of noise which can cause the direction to change as well, not just the significance, but also the sign that you're getting. It could depend upon this bid-ask bounce because of all these noise in the prices.
Okay. So it's basically again the same answer. We in the amount of time we had, like, we tried to check as much as possible about this estimation window, because we know it's really kind of the crucial aspect there, and that's something we should look at more closely again, like the bid-ask spreads. But basically, I think we had no indication that we had this bounce between the bid and ask spreads, because normally there was really quite a clear direction in the estimation window, even if this might be kind of different from the fair value of the company because of the thin trading. But that's basically what we found.